Hello, and welcome to the Breakdown Lane.
Markets move fast, and so should your understanding.
As a consultant, contractor, or advisor, you bring specialized skills to the table, and companies, especially startups, often compensate you with more than just cash. Equity, in the form of stock options, can be a significant and potentially lucrative part of your compensation package. But here is the critical part. The equity you receive as a non-employee is treated very differently from the equity given to full-time employees. The rules, the process, and especially the taxes come with their own unique complexities. In this guide, we're going to break down everything you need to know about the most common type of equity you receive: non-qualified stock options, we'll cover what they are, how they work, the crucial tax implications you must understand, and the strategies you can use to make the most of them. Section 1. What are stock options? A quick refresher. So, let's start with the basics. What exactly is a stock option? Think of a stock option as a special kind of coupon. It gives you the right, but not the obligation, to purchase a certain number of shares of the company's stock at a fixed, predetermined price. This fixed price is called the grant price, or strike price. The whole idea is that you receive this coupon when the strike price is set. You hope that over time, the actual value of the company's stock, its fair market value, or FMV, will rise far above your strike price. The difference between the high market value and your low strike price is where your profit comes from. Now, you may have heard of another type of option called an ISO, or incentive stock option. It's important to know that ISOs have certain tax advantages, but by law, they can only be granted to W-2 employees. As a contractor, advisor, or consultant, you will almost exclusively be granted NSOs. Section 2. The NSO life cycle for a contractor. Understanding NSOs is easiest when you follow their life cycle, which has 4 key stages. First, there's the grant. This is the day the company officially gives you the options. You'll receive a grant agreement that details everything: the number of options, your strike price, and most importantly, your vesting schedule. For example, you might be granted 10,000 NSOs with a strike price of $1 per share. Second, there's vesting. Vesting is the process of earning the right to actually use your options. You don't get them all at once. A typical vesting schedule is over 4 years, with a 1-year cliff. This means you get absolutely nothing for the first year. But on your first anniversary, the cliff, you'll instantly vest 25% of your options. After that, you'll typically vest a small portion every month for the next 3 years until you are 100% vested. Third, we have the exercise. This is the moment you actively decide to use your vested options to purchase the company's shares. You pay the company the strike price for each share you want to buy. So, using our example, if you wanted to exercise 1,000 vested options, you would pay the company $1,000. This is the single most important event for tax purposes, and we'll dedicate a whole section to it in a moment. Finally, there's the sale. This is when you sell your shares of stock on the open market, hopefully for a much higher price than you paid. Section 3. The critical part: how your NSOs are taxed. Alright, this is the part of the video you cannot afford to miss. The tax rules for NSOs are specific, and for contractors, they have a major twist. Let's go back through the life cycle. At the time of grant, when you first receive the options, there is typically no tax event. You don't owe anything. As your options vest over time, there is still no tax due. You're earning the right to purchase, but you haven't received any actual income yet. The moment everything changes is at exercise. When you exercise your options, the IRS sees it as a form of payment for your services. You have to calculate something called the bargain element. This is the difference between the stock's fair market value on the day you exercise and your strike price. Let's use our example. Your strike price is $1. Let's say today the stock's fair market value is $10. The bargain element is $9 per share. If you exercise 1,000 shares, you have a bargain element of $9,000. And here is the most critical point for contractors and advisors. That $9,000 is taxed as ordinary self-employment income. This means it's subject to your regular federal and state income tax rates, plus self-employment taxes for Social Security and Medicare, which is currently around 15.3% in the U.S. Employees don't pay this full amount. This tax is due for the year you exercise, even if you haven't sold a single share. This creates a major cash crunch. You need money to buy the stock, and you need a separate pile of money to pay the taxes on your phantom income. Section 4. Taxation at sale. Okay, so you've exercised your options and paid a hefty tax bill. Now what happens when you eventually sell the stock? This event is taxed under capital gains rules. First, you need to determine your cost basis. Your cost basis isn't the strike price you paid. It's the fair market value of the stock on the day you exercised. In our example, that was $10 per share. This is because you already paid ordinary income tax on that value. Now, the timing of your sale is everything. If you sell the stock within 1 year of exercising, any profit is considered a short-term capital gain. This is taxed at the same high rates as your regular income. However, if you hold the stock for more than 1 year after exercising, your profit qualifies as a long-term capital gain. These gains are taxed at much lower, more favorable rates, which can save you a significant amount of money. So, if you sold your shares for $25 after holding them for a year and a day, your long-term capital gain would be $15 per share for $25 sale price minus your $10 cost basis. Section 5. Strategies and risks for contractors. Given the tax complexity and cash requirements, what's the best way to approach this? Here are a few common strategies. First, the exercise and hold strategy. Here, you pay to exercise your options and also pay the associated taxes out. You then hold the stock for over a year to qualify for long-term capital gains when you sell. This offers the best potential tax outcome, but it requires the most upfront cash and carries the risk that the stock price could fall. Second, the cashless exercise. If you're low on cash, some brokerage platforms allow you to exercise your options and immediately sell just enough shares to cover the exercise cost and the taxes. You then get to keep the remaining shares. This is a great way to get ownership without a huge upfront investment. Third, the exercise and sell all. This is the simplest strategy. You exercise your options and immediately sell all the shares. This eliminates all risk of the stock price dropping, but you lose out on any future growth and the benefit of long-term capital gains tax rates. Remember the key risks for contractors. The company you're working for is likely private, meaning your stock is illiquid. You might not be able to sell for years, and of course, there's always the risk. The company doesn't succeed, and your options become worthless. Conclusion: NSOs can be a powerful wealth-building tool for contractors and advisors, offering you a direct stake in the success of the companies you help build. However, they are not a lottery ticket. The tax implications, especially the treatment of the bargain element as self-employment income, are significant and require careful planning. Before you make any decisions, model out the potential costs, understand the risks, and always consult with a CPA or financial advisor who specializes in equity compensation for self-employed individuals. If this breakdown was helpful, please hit the like button. And for more guides to navigate your finances, subscribe to the Breakdown Lane.